Now, interestingly, there's a lot of reasons it's kind of private equity, and part of the reason it's private is not public, and part of the reason of not being public, information is kind of hard to get to. So I fully admit that at one point I may have an opinion, I may say something, and these gentlemen may say, I see it kind of a different way. And that's part of the beast here in dealing with private equity, is it's not as transparent as the public markets, and sometimes information is a little bit harder to get to. But really, at its core, what is kind of, when people talk about private equity or venture capital, what is it? And I think a good way to describe it is to kind of chart it out. And what you see here on this one is that as the risk to investors go up, kind of right here, and you try to get different type of money, the cost to the entrepreneur also goes up, because the higher risk, the more the person that gives you the money is going to demand in return for getting you that money in the first place. So if you go all the way down, and you can probably go a lot lower than secured loans. So if you borrow against your house, if you borrow against your assets, if you borrow against plant equipment that you have, you will pay generally a low interest, because if you default on that loan, someone can come and take those assets from you, and so you're more likely to pay, and if you don't, they have something that you can sell. So without going through all of these, let's just take a pause and say most of us think of credit cards as being like, that's the most expensive kind of money you can get. Well, actually, if you keep going up this chain here, and when you convert at this point into actually equity investments, then you see that it really gets a lot more expensive. Sometimes in our community, I run into entrepreneurs who think, wow, wouldn't it be cool and sexy to get venture capital investment? And not really realizing that that's the most expensive type of money that anyone will ever take in. The effective cost to the entrepreneur is going to be the highest. If you converted it to an interest rate, you wouldn't even want to know what that interest rate would be. So it's extremely high, and that's what the money people are going to charge you for giving you some of that money.
Please.
Yes.
What's the difference between venture debt and venture capital?
Venture debt is a bit of a hybrid. So the reason I put it there in the middle, and kind of briefly, is oftentimes when a firm is able to secure venture capital investment from an equity investor, they can then turn around and go to a commercial bank like Silicon Valley Bank or a number of others, and those firms will actually lend money kind of secured by the venture capital money that you already have. So it's kind of in the middle there. You pay an interest, it looks like a loan, but it kind of comes in at the same time as venture capital investment.
If I may intercede, I want to save the question and answer till after, because we have three. I want to make sure that each of our speakers has an opportunity to do the full presentation. So, but please keep your thoughts and your questions. Okay. Okay. And so actually, keeping with the basics, I put the angel investment, venture capital, and private equity. So essentially, that is when you sell a part of your company. You give over ownership in a portion of your company through shares to someone else, which that means you also lose a bit of control. The payback is not necessarily always equal. In fact, oftentimes when you get venture capital or private equity dollars, you sell, say, a percentage of your company. Let's just make it easy and say you sell 30% of your company. Well, when you get your money back, you would think, oh, okay, well, I sold my whole company. This investor gets 30% of what I just made. Well, unfortunately, oftentimes in private equity, there's something called liquidation preferences, which means those folks generally get their money first, and after what's left over, they may get their money, in some cases twice. In really extreme cases, they may get their money back 3 times before the founder ever gets anything. So that's how you see that it starts to get very expensive. Generally, with equity investments, your investors are going to want to get their money back all at once. So one of the common misconceptions for inexperienced entrepreneurs that are working with us is they conceive of getting venture investment or equity investment, and they say, well, I'll pay it back through dividends or a share of the profits, or along the way I will pay back my equity investors, and then that way when I sell the company I'll get more for myself. That is actually very rare. Most institutional investors, VCs, angel groups, private equity firms, they are looking to get their money back in one big chunk when the business actually sells. So when you're looking for equity investment, you've already got to be thinking about, how am I going to sell this? How am I going to get a lot of money out of this to pay back the equity investors? Can you hit the space bar on there so I'll kind of quit walking back and forth? And the different types of equity investors, I'll go through this kind of quickly so that the other gentleman can go.
that at the level that I've listed, angel investors, which are generally, could be friends or family or high net worth individuals, or in some cases angel networks. And I think Jesus is going to go into this a little bit more. The VCs, or the venture capitalists, those are the ones that invest, roughly speaking, $500,000 to $5 million, but in some cases, could go upwards of, say, $25 million. And generally, those are venture capital firms or VC firms. They get their money from other investors, which are known as limited partners. Those can be insurance companies or pension funds or endowments or kind of high net worth individuals that have pulled their money. So essentially, they get money and then they turn around and invest money. And that's going to become important here in a little bit. VCs, and what's important to know, is they are swinging for the fences. They're swinging for home runs. In most cases, when a VC is choosing to pick his investments, he wants to convince himself, or she, that every single one of them is going to be great. They don't like to be approached with ideas that, this could be pretty good, and if we work on it, this could be a nice growing business. They don't generally look at that. They want something that's really big and can go all the way and eventually be sold. They're very diligent. So, a venture investment could take 6 months. It could take a year. It could take 2 years from the time you finally start talking to someone till you finally get the check. And then finally, one of the good parts is that they are very well connected. Since they know this space, hopefully, they're already looking to find out who they can sell this company to, how they can get the best advisors for the company, how they can get the best connections and the best customers. And so that is definitely one of the advantages. And then finally, the private equity firms. Since it is private equity, I thought I'd mention it. Generally speaking, when you hear of a private equity firm, although venture capital is part of private equity, when you hear of a private equity firm, generally speaking, those are large firms that invest big chunks of money and buy whole companies at once, and generally to provide growth equity. But they're still buying it, investing in it, and looking to sell it later on. But generally, a private equity firm isn't in the startup phase. They're not kind of the ones that you generally hear about. Can you do that again, please? What are equity investors looking for? Well, great management teams and experienced management teams. And so they may sound like the same thing, but generally speaking, if a VC can find someone who's taken venture capital money before, worked it out, and sold it, that's who they really want. They want to get those people that have done it before. They're also looking for huge markets. So I just put up 2 different numbers from 2 specific VCs that I want. One's in the medical device space. They don't look at the medical device space unless they can convince themselves that there's a $500 million US market for the device that they're selling, which is pretty massive. Another VC that I just met recently from Silicon Valley, he said they're looking for targets of markets that are $5 billion. And I'm like, you said $5 billion, right? And he's like, yeah, we realize that very, very, very few markets are going to be that size, but we want a $5 billion market. Generally speaking, VCs are looking for proven business models. So what I tell my entrepreneurs is, don't come to someone and say, this is a brand new way to make money. They're not generally interested in brand new ways to make money. They're looking for creative solutions for a way that already makes money. So if you are a software company, you sell your software as a service, or you sell your enterprise license, and people will want to buy that software, but you already know how it's going to be paid for. There are a few exceptions, and very, very noticeable ones, like Facebook or Twitter or something. When these companies started, there really was no business model. In some cases, you could say there still is no business model for those. But yet, they had huge customer traction. So if you could really show a ton of users, then you can get away with that. They want capital efficiency, which generally means it's not going to take a lot of money for this, and they're looking for big returns. Can you go ahead and hit my thing? The candidates for angel and VC, generally speaking, also are in certain industries. For the most part, an industry has to be big and growing for the VCs to get interested. So I just listed kind of some of them. Biotech, which is big here in San Diego, and in that case, they're generally looking for proof of principle and some kind of safety studies that show that the drug that you're developing may be safe. In medical devices, they're looking for a large unmet medical need, a proof of concept, and some idea that you know how this is going to get through the FDA. For software as a service, generally speaking, if you can show that your software, you can sell it for a lot less than what it's eventually going to be worth to that customer. So if your customer acquisition costs, let's say if you're a software as a service on the internet and it costs you $3 to get every customer, but over that lifetime that customer is going to be worth $12, then that could be a good issue for you. I'm at my 12-minute point, so I'll go quickly here. Clean tech, generally speaking, good economics. So if you've got a wind turbine, you've got to be able to show that that wind turbine can create energy at a lower cost than, say, diesel or whatever's out there. In mobile, computer infrastructure, essentially proven customer interest, and then prototypes. And then kind of the state of the VC investment right now, it's a tough market. In general, more money has gone out of venture capital firms than they've been able to raise. Remember, VC firms have to go get investors themselves, and for 3 straight years, they haven't gotten as much investment as they've actually invested in other companies. That is not sustainable. So what that means is that the VC industry is probably going to contract at least 30%. Part of the reason is this stretch from 2001 to 2011, which is the time frames in which a lot of VC firms are measured, was a horrible stretch. So they had such lousy performance, you would have been better off putting your money definitely in the stock market and probably as low risk as bonds, and you would have done better than that. So there's kind of a bad rap out there, so no one wants to give them new money. The other thing on the state of the VC industry is that kind of small is the new big right now. So these firms are really finding that it doesn't make sense to raise a whole lot of money, because if you want to make your money back, you've got to sell all your portfolio for a whole bunch of money. So maybe something more in the $75 million range for a VC firm makes a little bit more sense. And there are a lot more accelerators and regional funds because of that. And what it's turning into is essentially there's kind of a barbell effect. The big firms, the Kleiner Perkins, the Sequoias, the Canaan Partners that you hear about, they're raising massive firms around $700 million. And then there's a lot of smaller firms, but kind of everyone in the middle has been taken out. And here's my information. If you want to check it out quickly, I've got my business cards, and I'll be around afterwards to answer any questions. Hopefully I set the stage well.
Okay, Luis, we want to thank you very much. Clearly, the panel are the ones that do the true ABCs. So we're really going to encourage you after this event to get his card, talk with them, follow up. I kind of apologize that we're running late because of our earlier event. Okay, the next person I'd like to introduce is Ricardo Tejera from Municipal Capital.
Sure, you got it.
And he's going to talk a little bit about domestic equity funding and international domestic investment.
Okay, so it's a fast-paced workshop. So now we're going to actually shift in terms of talking about financing projects overseas using equity financing. So essentially what Municipal Capital, what we do is we actually are a private equity firm that invests in U.S. companies that are growing internationally. So for those of you entrepreneurs here in the room that currently have U.S. companies that are thinking about exploring markets internationally, and the bank that you're currently working with might not be able to take you to that next stage, that's where we come in. So, thank you. So a little bit more verbiage of what we do and who we are. We have several offices. We have 2 offices in LA. We have an office in South Korea where our money is raised, and then we have an office in Cuenca, South America. Okay, so our debt financier, our fund that we use, is the Overseas Private Investment Corporation. They've actually been around since 1971. They've been in financing developing countries for 71 years, or since 1971. And they've actually, it's a U.S. government agency like SBA, but what they typically do is they actually just work for companies that are growing internationally. So they're the developmental financial institution for the United States. What that means is that they could actually finance your company growing internationally debt-wise. Okay, so the equity part is where we come in. Next. I'm going to go really fast because there's a lot of things to cover, but please see me after if you have any questions. So the general products, project finance, debt, and equity investment funds. So that means anyone that's looking to start a venture fund or private equity fund, we actually invest in that. And then political risk insurance. For the investments that you are going to be investing overseas, we obviously want to have some hedge against that risk. Next. Okay, so what type of investments do we support? Specifically private investments, and essentially nothing in terms of government participation. You can have some government participation, but it can't be more than 49%. So it typically has to be private investment. We invest in over 150 emerging markets. So what that means, we're investing in the markets that are actually growing, that are not saturated, unlike some countries like we know of, ours, that is contracting currently. So we're looking at emerging markets, Sub-Saharan Africa, Southeast Asia, Latin America, so emerging markets. Okay, so it has to assist economic growth, facilitate private investment, and operate at a self-sustaining basis. And it has to basically be viable on commercial terms. And it can't compete against private sector. So that means if your bank could finance it, we don't want to go ahead and compete against it. Okay, so our priorities. Renewable and clean energy. So if we're talking about waste to energy projects, solar projects, specific renewable energy type of projects, biodiesel. Those are the types of projects that we're prioritizing our funds for. Housing and real estate, and banking and finance. Geography, like I said earlier, Asia, Southeast Asia, Sub-Saharan Africa, Middle East, and North Africa. Next. So we support and finance investments with substantial U.S. participation. We have to have 25% U.S. investment participation. So there has to be a sponsor that at least has 25% ownership of the project, meaning that there has to be 25% U.S. equity into that project. It promises significant benefits, social and economic development. So what we look at is a double bottom line. We don't only look at just profitability, but we want to make sure it's actually creating a developmental impact. And of course, it fosters private initiative. Again, it has to be a private enterprise for us to be participating. Next. Okay, so the parameters of our equity financing. The amounts that we invest in, and as Luis illustrated earlier, we're not really in, we could do a startup, but it has to be startup that's really substantiated with a management team that has a track record in that type of field. So for example, if there's a company that's coming to us that's a SPC, a special purpose company, or SPV, a special purpose vehicle, it's a new entity, but the founders have 25 years, 30 years, what have you, in that specific industry. So if we're taking a specific example, let's just say solar energy. If we have an investor that's looking to develop a project where a need of energy is high, and they're looking to develop a solar plant, well, they can't be new to the solar industry. They can't have no experience in the solar industry. They will need to have a lot of experience, have run other companies before, have already invested, sold, what have you, and then are starting a new project. Those are the type of individuals that we will work with in terms of startup. But most of the time it could be an expansion business. So if they have an operating existing business here and are looking to grow overseas, and they need capital to do that, but unfortunately their domestic bank cannot go overseas, that's where we come into play. So the typical injection is between 10 to 35% of the total project cost. So that means if your project cost is, let's just say, 10 million, we will only invest in terms of our own equity between 10 to 35% of that total project cost. There has to be a minimum investment of the sponsor, typically between 10 to 20%, because as most angel, private equity, and venture capitalists, we will not invest in pre-development money. And what I mean by that, pre-development phase is your feasibility studies, your overall R&D, a lot of what we would call pre-development phase of a startup. Most angels, and this is the perception of what a lot of small businesses have a misconception of, is that an angel or a venture capital firm or a private equity firm will invest in your business without any of this work done. That's typically 100% not correct. You need to have some traction, you need to have a lot of R&D, you need to have some sound business plan, you need to already have some clients in hand, and then you really need to show that there's a lot of scalability to your business model. So that's typically what we're looking at as well in terms of financing a project. And again, the typical injection is between 10 to 35%. We have a very different criteria in terms of what we're looking at in terms of our internal rate of return. Because every market internationally is different. Say, for example, if I'm in South Africa or Africa, Sub-Saharan Africa, The risks are going to be very different as opposed to Latin America and Mexico. Politically, the stability, a lot of different things fall into place in terms of our underwriting criteria. So there has to be a minimum country internal rate of return for us to be able to invest in that. And you can ask me specifics of your country later. Obviously, there has to be a U.S. Participation again. That's where OPIC comes into place in terms of debt participation. Your bank, if they're going to provide some type of debt, then that's where we like to have that other financier involved. We don't like to be the only investor involved, whether it's debt or equity. We have to have some other participant in the transaction. We have to have a secure off-taker. So this is very different from small business. When you're a small business, typically you don't have a customer in hand. You're starting with a vision, and you're looking to go get sales. Unfortunately, with our money, with our funds, we need to already know that the project that you're developing is essentially already pre-sold. I know that sounds a little bit obvious, but it's very difficult in certain cases. But in the cases where we do work with clients, a lot of the times that we do work with certain clients, they develop a plan based on the need that someone's already requesting. Say, for example, housing is one of our priorities. A government that says, okay, if you provide this housing, you provide the development, you provide the financing equity, we'll go ahead and buy this once they're built. So there's already in line a buyer, most likely. Does that make sense in terms of off-taker? Everyone clear on that? Okay, okay. So sovereign guarantee, essentially, if there is a larger entity that's going to provide some type of guarantee, if there is some type of default in place, typically a large corporation or some local government entity. And then, of course, we're looking at the exits. Next. Debt. Between 500 to 250 million per project, 75% for expansions, 65% for startups. Repayment terms between 3 to 20 years. Obviously, looking at purpose of loan, projections, your business plan, what have you, feasibility. And we'll take quarterly and semi-annual payments, grace period, and principal during startup. Cost of financing is based on treasury rate. We'll basically have a spread on top of that. Other fees are very consistent with commercial rates. So if you're looking at bank, we're going to be very similar in terms of our pricing for debt. Next. And that's it. The next steps are how we work, but I could save that till after if you have questions. I'll have Jesus continue.
Jesus, I want to thank you. Thank you, Ricardo.
Thank you.
Clearly, there's a lot more.
Thank you. I have a 21-page PowerPoint presentation, so I'll spare you with that.
You could turn that on.
How many are seeking private equity financing? Nobody?
I know.
I want to see your hands. In other words, no debt. Again, please. How large is your business?
Micro, small.
Okay. I'm going to give you some statistics. You don't have to write them down, because I teach this course over and over, and we're running a book about this, and I cannot, my job is going to be today to dissuade you from accessing private capital. However, I will also give you the fact that it's turbo capital. It's a form of capital that will get you to the next stage you never thought possible. Now, how many Latino-owned firms are there in the United States? Give me a number.
3 million.
What's the question again?
How many Latino-owned firms are there in the United States?
3 million.
8 million.
Let's take 3 million. There's 30 million businesses in the United States. Let's take 10% of that. It's 3 million. How many do you think are multi-million-dollar companies?
Around
1%, 5%.
no, around
Come on, give me a number.
around
How many of you are in business now? Good, you guys are decisive. Give me a number. Give me a number, please.
Probably 5%.
Multi-million. Multi-million sales.
140, something like that.
50 million.
Okay. 1.78, roughly almost 2%,
Mhm.
which means 44,000
44.
out of what? 3
3 million.
million.
Yeah, yeah.
What happens to the other firms?
That is small. Yeah.
92% make sales
Mhm.
less than $250,000 a year
Mhm.
and have less than 5 employees. Now, knowing that and knowing the criteria that you just learned, what's the probability of seeking funding or being eligible to secure funding from private equity or venture capital or an angel investor? Kind of low, no? So, you saw the curve, risk. Which was the lowest risk level that you saw in that graph?
Unsecure.
Debt.
Yeah.
Why would we ever consider private equity?
Mhm. When you have a business that is really scalable.
Very good.
Mhm.
You get an A.
Mhm. I used to get them in school.
I've been an angel investor for maybe a couple of years. Before that, I was an investment banker. Before that, I taught. And what got me into this business is because I want to send a message. Private equity or investment capital is similar to getting married.
Mhm.
You have to choose your mate well because you're going to be married from 3 to 7 years.
Mhm. Mhm.
Are you there? You also have to sign a prenup.
If you're smart.
Why? Why do you have to sign a prenup?
Love is not enough.
It's easy to get in, very difficult to get out. Are you with me thus far? So what does that all translate to? If you're seeking private capital, investment capital, be ready to get married.
Mhm.
Start dating as soon as possible. This gentleman to my right, they know what they're doing. I've just been at it a little bit longer. That's all.
Mhm.
I recommend that if you're seeking capital, start with angel capital. Why? Because they're good dates. They're more flexible. They're former business owners. They're executives that they do not know what to do with their money other than maintain liquidity at the local bar. What they're looking for is to feed their ego. What they're looking for is to get a return on their investment that is not like a venture capitalist. What was the return on investment that was quoted today?
Like 3 times sometimes, 50 times. It depends.
Try 20 to 30%. And they have to have net profit margins of 50% or more.
Mhm.
That requires a business that is scalable. And scalable doesn't mean making it bigger. What it means, maintaining your costs the same while you're increasing your revenues. And that's only within a specified range. It's called a scalable range. You can only do for so long. Then after that, guess what? Your cost of operations start increasing. I'm a big fan of venture capital. I'm going to tell you why. There's a friend of mine that runs the Venture Capital Center at a New Venture out of New Hampshire University. $22.5 billion were allocated to roughly 66,000 businesses. Venture capital, as of last quarter, $7 billion. And they go after the same industries.
Mhm.
So let's come back to the fundamental question. Do you really want to get married? Think about it. Any one of these gentlemen would come and be your marriage counselor. It's a seduction process. That's why putting it that way. You have to seduce your investor to believe that you're the only girl or the only guy at the bar. You have to convince them to the point that it's non-negotiable. That you're the only thing ever happened, that you're going to be the only person that has the widget that nobody else can have. I get attempted to be seduced, not daily, but let's say once a week. And I'm going to tell you, there's a lot of sellers, there's a lot of promoters, there's a lot of enthusiasts, but at the end of the day, reflect your passion in your business plan and what I call your value proposition. If your value proposition to me is incomplete, is cosmetic, and I don't believe it, it's not going to happen. I don't care how many drinks you buy me. Kind of industries we're interested. You don't have to take this down. Greening real estate. I like greening real estate. Mainly commercial, but we also like multifamily. Healthcare. Why healthcare? Can anybody tell me why? How large is the sector? How inefficient is it? How many incremental players are there? And how many Latinos have more babies? I also like the specialty food sector. We just invested in a company where we're making gourmet tamales, salsas, artisan salsas, empanadas. We have, it's just a multiplicity of products. The margin's 43%. Easy. Easy. So anything the specialty food sector we like, anything that's organic, anything that is healthy, this is why we like the healthcare sector, because they are complementary. There are other industries that we're interested in, and those are case-by-case basis because we cannot cover them all. The kind of investments that we make are minimum $5,000 all the way to $100,000. Why? Remember the statistic that most of us sell less than $250,000 a year? I'm looking for those firms that can go from $250,000 to $700,000 to $1 million. And then we'll team them up with a VC. But VCs are no longer what they used to be. They're behaving very conservatively, almost like private equity capital. And the new angel investors are, guess what? The new angel investors. There is crowdfunding coming up. Everybody knows about crowdfunding. If not, you can raise money through the internet. If you're an investor, your maximum is $2,000. But if you're seeking a donation through your crowdfunding, it can be all the way up to $250,000. The challenge with that is that it's new. The rules are coming up in another year. It's emerging very fast, but it's basically is cost driven. If you believe in the venture, then you invest. If you want to develop a square taco, and you can convince me that it's very, very healthy and that I can sell it, then we invest it. So, angel investor, there are a pool of investors that are informal, they're not called angel. There are angel groups. There's about 20 or 30 types of private equity investing that we're working on. But the bulk of it is, again, angel investing. I guess I got the message, right? Angel investing? You want to get married? 2, 3 items. Are we doing good for time?
We're doing good for time. If we could do a wrap up, then we're going to open it up for questions, and we have a lot of people here, I'm sure, that have questions.
Okay. Yeah, you guys get a 10% of the deal. Number one, if you have a company and it's revenue generating, in other words, you're making, not in profit, but you're making sales, that's good. Secondly, keep on building the company. Not as if you own the company, but as if you were going to sell the company. Most of our Latinos are talk about building legacy companies. Forget that for a little while when you talk about private equity. You're going to have to know the valuation of your enterprise when you get the next round of financing. You cannot get emotionally attached to it. So it's a marriage without emotion.
Technical.
We can go on that a little bit later, I'm sure. Here's the other insight that I'd like to provide you with. Shop. You got to compare. Do a little table, do a little matrix, do whatever it takes, compare, because every source is different. And then we call a term sheet. A term sheet is just a contract. It's your prenup. Do not negotiate the cost of the capital. Negotiate the terms of the contract. Don't focus on the money. Focus on all the other stuff that's going to leave you out, it's going to leave you in. Enough.
Okay. Okay, so do we have any questions here? We need to do it order.
Another question.
Anybody have a question? No questions?
Married
Okay,
counselor?
yes, sir.
No married.
Business card now because I have to.
Yeah, I do too.
Pardon?
Like the
Business
too.
cards.
Business cards. We can do that a little bit later, by all means. No questions? Comments?
What kind of rate of return do angel investors typically expect? You said it was less than...
It all depends who you talk to. It's negotiable. I would look at it in the range of minimum of 12% all the way to 30%. Depends how risky the way. All the elements that go to a business plan, your financials, your team.
But at least 12%.
You can, yeah, certain industries you would. But it boils down to the potential that they look at you, and also with your second round or third round of financing.
Okay, if we don't really have any questions, then I'm going to let each one of you gentlemen go ahead and do a concluding statement. I think you were very entertaining, very resourceful, and please, so let's go ahead and start off with you.
Sure. So for all the small businesses, obviously we're a little scary in terms of how much and how expensive equity financing is, but it definitely is a tool that you could utilize to grow your business to the next step. But just like anything, do your research, understand what the terms are, understand who you're getting married to, and really understand that they're going to be there to support you throughout the transaction to grow your business, and they're going to bring value, especially. So don't take investment without any other value besides just the money. Make sure that they're coming with another value proposition, saying that they could give you connections in this, they could give you introductions to this. So when you're looking at equity, don't just look at just the money. Make sure you're looking at the relationship behind where that equity is coming from.
Luis.
All right, my closing kind of twofold. One is within the private equity world, sometimes they refer to companies that aren't interested in private equity or venture capital as lifestyle businesses. And generally, VCs and angels don't fund lifestyle businesses. And what that means is that the founders want to create a business that makes a lot of money for them and supports them in a nice lifestyle. So VCs won't touch that. But the flip side is, if you're one of those people that has a business that generates a lot of cash and creates a nice lifestyle, what's wrong with that? So, it's not all bad to be in a lifestyle business. And if your business isn't good for VC or angel investment or private equity, that may not necessarily be a bad thing. The other part of it is, there was a recent study that really highlighted that for the most part in the United States, the venture capital industry is by far predominantly white and predominantly male. And so if you are not in that group right now, that may make it even extra daunting. But what I would say is that it's also and always has been a situation of who you know and who you're able to attract to your team. So, I'm never going to become a white male, just out of the question. But if I was going to raise a business and looking for someone that could help, the first person I could convince was someone that had already raised and successfully sold a venture capital business, then that could be someone that I want to connect with. So that's the good news. The good news is there are a lot of serial entrepreneurs out there or angel investors that you can connect with that could help you on that path. Sometimes the first person you have to connect is not the person with money or convince. You don't convince the person with money, you convince the person that's going to join you to help you build that team.
Good. Good advice.
And since there was no question, I think Jesus did his job. He scared everybody. Jesus, please.
Get yourself a marriage counselor. Seriously, you need to plan your exit before you plan your entry. Just at the same time you plan your entry, because eventually that investor is going to have to leave you. And that withdrawal process is, pardon my French, is B-I-T-C-H. It's very hard. What I would leave you is with this thought. Teamwork. You gotta have a team, because we invest in teams, we don't invest in industries. Have an infrastructure, have a lawyer, have a good accountant. Yes, a good therapist as well. Have your infrastructure. Without that infrastructure is los cimientos, la base de ese edificio. You can build this many times. You can have scalability, you can have whatever you want. But without that team, you need to get along with yourselves, among yourselves. We have a situation where we have to terminate an investment because the initial intent was really to do phenomenal things, but the fit eventually did not work out. So you need to be prepared for that. And the fit also manifests itself in selecting the angel capital source. If you don't trust it, if it doesn't feel right, don't do it. Go to the next one. Because you're the one that's bringing the venture to the angel investor, not the other way around. Okay? That's it.
Okay, any comments? I think one of the things to power and success is knowledge. You clearly having access to experts like this that are accessible and that are here for you is a gift that as an entrepreneur, as a business is looking to grow, is a blessing. I want to thank these three gentlemen right here. I really appreciate their time and their efforts. Please get their business card, because they're not only experts in their particular fields, they are actually mentors to small business advocates. I know these gentlemen in many different worlds, and not just in this equity finance realm. But please, get their cards, take advantage. I want to thank everybody here. It's one of the better attended events. Thank you very much.